What if I told you the most important financial revolution of our time isn't happening inside banks?
And it isn't happening in Bitcoin either. It's happening in something most people think is boring: stablecoins. Not because they go up, but because they replace what banks actually do, and once you see it,
You can't unsee it. This argument isn't speculation. It is grounded in recent academic research analyzing stablecoins not as speculative crypto assets, but as financial infrastructure.
one of the most structured frameworks appears in Banking 2.0, The Stablecoin Banking Revolution, authored by Professor Yesha Yadav, Vanderbilt Law School, and Professor Arthur E. Wilmarth, Jr., George Washington University Law School, published and circulated in 2023 through leading U.S. financial law research networks and fintech policy forums.
Both scholars specialize in banking regulation, systemic risk, and financial institutional design. Their core question is not whether stablecoins are good or dangerous. Their question is far more structural. What happens when the core functions of banking are unbundled? That question changes everything. Most people assume banks are permanent. You deposit money, they move money, they lend money. That's just how finance works. But history tells a different story. Banks are not sacred institutions. They are bundles of functions. And today, that bundle is being quietly dismantled, piece by piece. At their core, banks perform three essential roles. 1. Store value. 2. Move value. 3. Create credit. The core thesis of Banking 2.0 is simple but radical. Stablecoins already perform two of those three functions. They store dollar-denominated value. They move that value globally, instantly, 24/7, without branches, without SWIFT, without correspondent banks. That's not just innovation, that's disintermediation. Most people compare stablecoins to Bitcoin. That's the wrong comparison. Bitcoin challenges money. Stablecoins extend money into a new infrastructure layer. A dollar stablecoin is not a new currency. It's a digital wrapper around the US dollar, living on programmable networks instead of bank ledgers. And that changes everything. Because when money moves from bank databases to open settlement rails, control shifts. Not visibly, but structurally. Here's where the story becomes geopolitical. Most dollar-backed stablecoins are backed by cash, short-term U.S. Treasury bills, which means every stablecoin issued creates demand for U.S. government debt. When someone in Nigeria, Argentina, Turkey, or Vietnam holds a stablecoin, they are indirectly holding U.S. treasuries. Outside the U.S. banking system, outside U.S. territory. That is a new transmission mechanism for dollar power. As Yadav and Wilmarth note in their analysis, stablecoins may expand global dollar demand without expanding U.S. banking presence. No treaty required. No military alliance. No diplomatic negotiation. Just adoption. This may be one of the most efficient channels for global dollar expansion ever created. Pause here. If stablecoins strengthen the dollar while bypassing U.S. banks, is that financial genius or a systemic blind spot? I want your position in the comments. Not interesting video. Tell me directly. Are stablecoins reinforcing American power or quietly weakening its financial institutions? If this question feels bigger than crypto speculation, hit like, because we're analyzing structural power, not price charts. Functionally, stablecoin issuers resemble something very specific. 100% reserve narrow banks. They take in dollars, they purchase safe assets, they issue redeemable tokens, they do not transform maturity. They do not create credit. They do not leverage deposits. It's banking stripped down to its safest core. Money in, safe assets held, tokens out. Which raises a dangerous structural question. If payments no longer require banks, what are banks for? Because if the most politically stable part of banking is payments, and that function migrates elsewhere, the remaining function is credit creation. And credit creation is where fragility lives. Here's the paradox. Stablecoins bypass U.S. banks, but they may strengthen U.S. financial dominance. They expand global dollar usage, increase structural demand for treasuries, embed the dollar into next-generation financial rails. This is dollar hegemony without diplomacy. The dollar doesn't need to conquer. It just needs to be programmable. But this transformation is not risk-free. Yadav and Wilmarth emphasize several systemic tensions. First, bank disintermediation. If deposits migrate into stablecoins, traditional banks lose low-cost funding. Less funding means weaker lending capacity, which means slower credit expansion, which means structural contraction risk. Second, treasury market concentration. If stablecoin issuers become dominant holders of short-term government debt, redemption waves could ripple into sovereign markets. A digital bank run doesn't require lines outside a branch, it requires a click. Third, monetary policy blind spots. When payments move outside regulated banking rails, central banks lose visibility. Policy transmission weakens. Money velocity becomes harder to measure. Stablecoins may stabilize payments while destabilizing monetary control. And here's the moment I want you to really think. If a financial crisis starts in stablecoins, who rescues the system? Banks have lenders of last resort. Stablecoins don't. So tell me in the comments, should stablecoin issuers have access to central bank backstops? Yes or no? There is no neutral answer here. If you believe this channel is discussing the architecture behind power, subscribe, because we don't chase headlines here, we analyze systems. This is why the transformation is called Banking 2.0. It isn't about better apps, it's about role reassignment. Just as streaming separated content from broadcasters and email separated communication from postal systems, stablecoins separate payments from banks. Banks won't vanish, but they may no longer be central, and centrality is power. So the real question isn't whether stablecoins will grow, it's who controls the rails when money becomes software. Because once money runs on code, authority shifts from institutions to infrastructure, and infrastructure always wins. Are stablecoins the next stage of dollar dominance, or the beginning of a system no nation fully controls? This isn't just a financial story, it's an architectural one, and architecture decides power long before politics notices. The financial system isn't collapsing, it's being rewritten, quietly. And the rewrite has already begun.
Plugging into the system, searching for a way out. Virtual reality world of no doubt. Hacking the code, searching for a clue. Trying to find an answer, something to break